Folks, if you're in the private equity business, the two best words anyone can utter are successful exit. That's because to generate the kinds of returns their investors expect, we're talking about 15% a year or more, private equity firms can't make like Warren Buffett, buy companies and hold them forever. They have to get out, exit, either by selling the company or taking it public. And this year is shaping up to be the best since the start of the financial crisis for successful exits. For more on this trend, let's check in with our good friend Iyan Adewuya at the Deal Desk. He's Bloomberg Senior M&A Analyst live this morning from London. Iyan, welcome back to the show. Let's talk about it. Private equity, M&A, and IPOs. What are we seeing?
It's a great time, to be honest. And when you look at the number that came up to me this week that really stunned me was $51 billion. That's $51 billion year to date in M&A exits for private equity companies. And they're finding a very good market with which to sell portfolio companies. So when you look at all the stories that came through our desk this week, including just yesterday, Nycomed. If Nycomed gets sold to Takeda at really high valuations, then Nordic Capital and DLJ Merchant Banking are going to be walking away very happy. The same thing goes with Warner Music. That got sold at very high valuations, and its private equity owners walked away very happy. Same thing to do with Skype, as private equity investors there tripled their money over an 18-month period. It's very good work if you can find it.
Very good work indeed if you can find it, and we're showing some of the people involved there, including Len Blavatnik. But let's talk about the difference between M&A and IPOs. In the case of a merger or an acquisition, you're out, you're gone. You've exited successfully from the moment that deal is completed. In the case of the IPO, it can possibly be even more lucrative because for the most often, when you take the firm public, the private equity firm retains a stake in the business, and if investors bid up the shares, your return can continue to increase, right?
And that's a very good point, because a great case study of that is the Warner Music situation, where it was taken private, it was spun off, taken a hold by private equity firms. As soon as they got a hold of the company, THL and the other owners, they took a dividend from the now private company. They later reorganized the company, went public, presumably were able to cash out again a little bit of their shares, held the company for a period of years, and now are getting taken out again. And so there are multiple ways these guys are able to monetize their investment. And yes, there's a two-track process right now, which is wide open for them, because not only are valuations very, very good and very hefty with M&A exits, you also have the ability to do the IPO track. So you see what Skype was able to balance that and saying, hey, we're going to do an IPO. And before they were able to complete that process, you had a very motivated buyer come in.
Iyan, in the case of IPOs backed by private equity, is it really, at the end of the day, just a function of where the stock market is and what the valuations are? Because if I look back, in 2008, it was pretty much impossible for a private equity company to take one of its portfolio firms public. Only $3.7 billion of deals were done. This year already, $14 billion have been done. We're on pace to exceed last year's total of 27.
You're absolutely right. It's kind of a chicken and egg debate with the equity markets, which is that the equity markets are waiting for confidence from the broader markets. And then when the broader markets react negatively to any piece of news in the broader global economy, then the equity markets shrink very quickly. So you find that the IPO markets are very volatile. Companies are very willing to get into the stampede you're seeing now to float publicly. But as soon as there's any piece of bad news, that pipeline can close. So the risk I actually see is that you have this frenzy of companies rushing for IPOs now. Right now, you have $14 billion in priced private equity-backed IPOs. That's 30% of the global deal volume globally. And so that's pretty stunning to me. And you look at the pipeline, and it's pretty full. You look at companies like Freescale, like Dunkin' Brands, LinkedIn, Pandora. These are companies that are in the pipeline today.
Yep.
And so there is a real risk here that things might become too clogged.
Right. Things might begin to correct, and those who have their fingers caught on the ledge might be in trouble when the private equity window for IPOs slams shut. Iyan, thanks as always for joining us. Iyan Adewuya on the Deal Desk.